Welcome, Mr. Denome. There are only two things that you can trust in the markets. You can always trust people's greed and you can trust people's panic. And in this video, we're going to take a look at a lot of different macroeconomic indicators. And I'm going to make it very, very simple. It's not going to fly over your head. It's going to be very, very simple to basically determine and to see if we are headed into a massive greed phase or if people are actually going to start to panic. And this is going to be very important if you hold Bitcoin or crypto specifically, because those are the assets that almost always the bull market ends in a greed phase. But to have the greed phase, you need to have macroeconomics line up to actually have a lot of capital for people to invest. And if people don't have capital to invest, they cannot be a greed phase because people will be panicking rather than greeding out. So in this video, we're going to take a look at a lot of these different indicators. And the first one, I will start with the most scary indicator. And gradually through this video, we're going to look into more and more better and better indicators. And by the end of the video, we can basically conclude if we're going to see a massive panic or if we're going to see a greed phase. And then you can basically decide if you want to exit the market before the greed phase, or enter the market before the greed phase, or exit the market before the panic phase. So anyway, let's first take a look at the household savings. And this is a key indicator here because as you can see, this peaked at 2020, that households had an approximate of $2.7 trillion. And this was basically because of all of the stimulus money from the COVID relief packages. And since 2020, you can see that this has rapidly fallen off a cliff. And right now, households only have $800 billion of savings, which is still a lot. But this is money that people probably don't want to waste. And this latest number is from 2022. So unfortunately, we do not have an update, but we have other data points that I will look at very, very soon to basically determine if the trend is the same or if it has improved. But anyway, looking at the 2022 number, you can see that this is almost at the same low as 2013, or even going all the way back to 2009, 2010. So we haven't seen these numbers, these low numbers, in a very, very long time. And when we take a look at the S&P 500, which is at an all-time high, or all of these different tech stocks that have jumped to new all-time highs like Nvidia, who is going to be the last sucker to buy those stocks? Because as you can see, the normal people, or let's call them retail investors, don't have money. They don't have excess savings anymore. So this chart to me is extremely terrifying. And this basically just indicates to me that smart money is also looking at this chart and they are thinking, who is going to buy this stock from me? Or should I sell this stock before other smart people start seeing that I have this stock and nobody's going to want it from me? So eventually, if this trend continues, there's just no more buyers in the market and the markets have to crash. So this is why it's a terrifying chart. But this was the most terrifying chart here. And if you made it to this far of the video, I just want to congratulate you because it will get easier from here. And by the way, if you like this kind of content, make sure to hit the like button and subscribe to the channel as well. Next up, let's take a look at the consumer loans. So this is credit card debt and all the other, let's say, short-term debt. And as you can see, this peaked here at 2020 as well. And then we had the COVID relief packages come into the market. And you can see people are paying off their debts. But then the relief money basically stopped at 2021. And since then, people started to accumulate their credit card debt once again. And by 2022, they already were back at the same number, $800 billion in debt. And now we're all the way up to over $1 trillion in consumer debt, which is just a massive number. So when we compare the amount of debt to how much savings people have, you can see that the savings are less than there's actual debt in consumers. So this is again just explaining to me or showing me that retail investors don't have any money left. And next up, when we take a look at real disposable personal income. This is a chart that tries to show us basically what's the monthly income of people. And it peaked here at 2021 once again, and since then it actually has crashed down. And the low was 16,000 billions here in 2022, and by 2024 it has gone up in the last 2 years, but now we're looking at 17,000. It's still down about 15% from the absolute top here, but it is going up a little bit. But even though this is going up, this is not inflation adjusted number. And because it's not an inflation adjusted number, so from the low, it has gone up about 6%. But when we take a look at the CPI, or the consumer price index, this tries to basically track the cost of living and the cost of buying anything from the market. And at 2020, you can see this number was about 260. And from there until May 2024, the number is now 313. So roughly 50 units higher than it was in 2020. So, or 55 units higher than in 2020. So that means that the price of living, the price of goods, everything has gone up roughly 20%. So if we look at the disposable income, which has gone up 6%, but the cost of living is up 20%, you can see that the real disposable income is actually much less. I don't think this is inflation adjusted. Let's take a look at inflation. Actually, let's take a look at this, because now I am doubting myself. I will go back to what I was explaining soon. Yeah, this is not inflation adjusted number. I'm pretty sure about that because they are not saying it. They are seasonally adjusted annual rate. Okay, so it's not inflation adjusted. So that means that basically people are down on their expenses roughly, 20 minus 6, so 14-15% down in the last 4 years. So that's a little bit worrying. Then next up, I will, by the way, go back to the CPI number, because this will go down and that will be part of the good news, but we will take a look at that soon. But next up, let's take a look at the unemployment rate. So here's the first time where we start to see a little bit hope. So here you can see that the unemployment rate was all the way up at almost 15% in the United States, and it has gone down to now 4%. So this is very, very good that people are actually employed, even though their disposable income has gone down. That means that people at least have jobs and means to provide for themselves. So this is quite nice. But on the flip side, and this is the bearish thing, is that whenever the unemployment is at a low here, you can see that it is followed up with a recession. Same here, same here, same here, same here, same here. And every time basically there's a low in unemployment, you can see a recession is just creeping in. And that's why we might be just in for a recession quite soon. And by the way, why we are looking at United States numbers and not other numbers, the reason is that United States is the leader of the world as of now, and they basically dictate if there's going to be a global crash or if companies or governments start printing money in droves. So that's why we're looking at United States. And just because it's very hard to compare country to country, so it's easiest to look at the biggest country or the most important country in the world as a leading indicator, let's say. So unemployment is this. Next up, this is the housing price index of United States, and this tracks the latest sale prices of houses. And as of until 2024 Q1, this number has still gone up just a little bit. So this has clearly slowed down, but at least housing prices have been going up. And whenever housing prices are going up, it usually means that they are still good times. But unfortunately, like I said, this has slowed down. And when was the last time this actually slowed down was in 2007, right going into 2008. And then we had the recession. So this is again kind of showing me that there might be a recession looming. And because you saw that people don't have disposable income, they don't have savings, so the asset prices basically, or the housing prices, have to come down, or we need to get another government intervention. quite soon, or we will see a crash. So this is looking to me like there will be a crash quite soon in housing prices, and usually that is followed with a recession. So this is housing prices, and by the way, whenever these are going up, it doesn't also mean that the demand for houses is going up at the same rate. And the indicator to look at that is the monthly supply of new houses in the United States. So this tracks basically how many months on average it takes to sell a new house in the United States. So whenever a constructor builds a new house, it takes some time before it actually is sold to a new buyer. And whenever this number is at a peak, so it takes like 12 months or 10 months to sell a house on average, that is usually when you see a recession here. So whenever this is peaking, you usually see a recession. But right now, you can see in 2022, this peaked over at 10.6 months to sell a new house. We didn't see a recession for some reason, I guess because we still had a lot of savings going on. But lately, even though this crashed in 2023 and there was a lot of buying here, you can see that this number has started to climb once again in 2024, which means that the buyers are not doing good. You can see that people are being squeezed, and this just means that we're reaching the danger zone basically. So looking at the this number here is kind of giving me an indicator that the disposable income has not improved in United States, at least so people don't have as many savings and so on and so forth. So like I'm talking about these numbers, these end in 2022. So I don't think they have improved a lot by 2023 or 2024. They have probably improved, but not a lot, because now we have the problem of inflation, which we didn't have in 2021 or 2022 yet, as much at least. So now those are the things that are scary. And now finally we can start talking about the good stuff. Because there's always some good and some bad. So now we can finally turn into the good stuff. So the first good news is when we take a look at the global price of energy. And this is very, very, very important, because when we take a look at the price of energy, everything else in the economy is a derivative of energy prices and the availability of energy. The more energy a country has, the more wealth it has. And the lower the energy prices, the more people can buy goods and services. So everything is basically a derivative of energy prices. And as you can see from 2022, this has actually calmed down significantly. So now we're basically at sustainable levels once again. So this is very, very nice. This could be disrupted by wars or whatever going on in the world, some pandemic, or I don't know what's going to cause a problem here. But all in all, right now, historically speaking, these are at sustainable levels, these prices, in my opinion. So this is very, very good, because it means that cost of creating goods and services is down, the cost to actually drive to your work is down, all of these things are down, so this is very, very good. But this also means on the upside that the disposable income has probably gone up for people in United States as well for the last year or so, because the energy prices have come down. So that's very, very nice. Also, when we take a look at the strategic petroleum reserve, this basically tracks how much United States had oil in reserves in case there's an emergency like a war or like a pandemic. And you can see in 2020 they started to burn the petroleum reserves at a very fast rate. So they basically cut the reserves by half until 2023. But from 2023 you can see that they've started to increase the reserves once again, which is very, very nice, because we don't want to see a massive panic on energy. So this is, in my opinion, very, very good, and that they've been able to increase the reserves even though the prices have come down. So this is very, very nice. I don't expect the energy prices to fall down any further, because United States will need to fill this up all the way to 600 So there's a lot of filling up that they need to be doing to fill up the reserves once again. So that will basically create the bottom demand for energy. So I think United States will be buying a lot of oil from the market, or just not selling to the market. So there's that for energy, and that is actually reflected in this chart here. And this is the most important chart that I will show you in this video. So this is the PPI, or Producer Price Index. So this tries to track the prices it takes to produce a good or a service. So it takes into account energy, it takes into account wages, taxes, all of these things together, and it is a leading indicator for CPI. So as you can see, from 2020 to 2022, you can see that this number was at a low of 185, and then it went all the way to 280, which is almost an increase of 50%. So it costs 50% more to produce a good than it did just 2 years before. So that eventually had to be reflected in CPI, which is the price that the end products, the end consumer actually pays for the product or service. So as the companies raise their prices to adjust to these the cost of making or producing the good or service, those prices are sticky. And usually whenever you go to a hair salon, if they raise the prices, they will never lower the prices once again when people are used to the new price. So prices will only continue to go up. But as you can see, the price to produce stuff is going down already. And it's gone down to 250 from 280, which is a price decrease of about 10%. So this means that companies that raise their prices now suddenly have additional profits under the bottom lines. So this is very, very good for potential price increase of stocks that actually produce goods and services. And I'm talking about stocks that have good price to earnings ratios. So for example, and this, by the way, ties into AI as well. So artificial intelligence has allowed companies to lay off staff members who've been doing like graphics designing, marketing, speech writing, chat operators, these different people basically doing creative jobs. AI has taken a lot of workload from those people, so companies no longer need to employ such a big teams. So companies that produce real goods and services in the real world, I'm not talking about digital services or digital goods. Whenever you produce physical goods and services, whenever the cost of goods goes down, that will be reflected in their products and services. And companies that also do a lot of marketing have decreased the sizes of their marketing teams. So if you find a company with that profile, they will be probably doing quite well going into the future, let's say 1 to 2 years. So let's say companies like McDonald's maybe, or Coca-Cola that are known for the physical product, but also do a lot of marketing. Those probably will have very nice profit numbers under their bottom lines. Even if their revenue goes down, just because they've been able to cut a lot of their costs, they will be making profits. So that's very good for those kind of assets. But on the flip side, if we look at, let's say, tech stocks like Nvidia, which is highly speculative, or when we talk about crypto, which doesn't really, or many crypto companies don't really provide cash flow, it's a speculative asset. This is not helping us basically. It's good for like, let's say, normal stocks, very good, but for crypto, it's much more important to take a look at the household savings and the disposable income. Because when we take a look at this is the money that will be thrown into speculative assets, and this is at a low here. So this is basically canceling out any altcoin mania or anything like that, bull market for Bitcoin like 200k. So I don't think that's gonna be happening. Obviously, that could still happen if these companies that suddenly have additional revenue, additional profits. If they start allocating those profits into Bitcoin, then Bitcoin could be doing very, very well as well. So there's that dynamic to be played, but those companies will not be investing in altcoins. So that's why altcoins are not in a very, very healthy place. Let's say that. Anyway, going further, why I'm saying that CPI will crash down is when we take a look at the CPI, it went from 260 to 313, which is the increase of 50 and an increase of 20%. So when we take a look at the PPI, this was roughly at 200, this index price here, and now we're looking at 250, which is also an increase of roughly 20%. So now when the CPI and the PPI both match together, there's not really any reason for CPI to continue to go higher, because companies are already making the profits. They don't really need to increase prices, and the consumers are already feeling the heat. They are being basically squeezed in the market to their absolute limits. They are using their credit cards, like we saw the credit card debt going all the way up here, even until 2024. That's very, very bad for consumers. So there's really no reason or no ability for companies to raise their prices anymore, at least as of now, immediately. So I'm sure CPI will come down as well very, very soon in the nearby future. It's just like a fact of nature. It will happen. So there's that. And now let's talk about global energy consumption as well. So global energy consumption will continue to go up, as it has gone up throughout the advancement of humanity or civilization. So every developed nation consumes more energy than developing nations, and as developing nations become more developed, they will need more energy as the people get wealthier and wealthier and wealthier. So we will need a lot more energy. And this is a very interesting chart here, because as you can see from the bottom here, that the total consumption of energy right now globally is 178,000 terawatt hours, and that is it's a lot, obviously, and we will need more energy going into the future. So this is just some investment ideas. Let's say that what should you invest in? Well, nuclear, this is an asset that I was quite bullish on for a long period of time. But as you can see, people are not, countries just don't want to spend on nuclear power. It's just gone flat for 20 years already. So nuclear energy, even though I think it's a superior form of energy, countries just don't want to invest in nuclear. And oil, coal, the coal is similar. For the last 10 years, there hasn't been an increase in coal energy consumption. Natural gas has gone up, oil has gone up, but even oil and natural gas both, they are, let's say, there's a high regulatory risk that these will go up in the future. You can see that oil still is almost 1/3 of all of the energy consumption in the world, and natural gas is the second highest form of energy that people use. So even if they slowly go up, it's a significant number, but the real gains to be made are pretty much in solar and in wind production. As you can see, there's a lot of incentives to create these windmills and these solar panels all around the world, and other renewables as well. So if you are looking to invest, these are probably one of the best places to invest in solar and wind going into the future, because this is the trend. People want to invest in this, and governments all over the world are very, let's say, pro solar, pro wind going into the future as well. I guess I don't know what else is there to say about this. I don't know. The amount of renewable consumption here is not a lot, but it starts to almost be the same as, let's say, natural gas. So solar is 3,000, wind is 4,000, biofuels 1,000, other renewables 2,000. So all in all, these are together 10,000 and then hydro is another 10,000. So 20,000 in renewables basically as of now, which is quite nice, and I'm happy to see that grow into the future. I've been quite worried in the past that these are not growing fast enough, but now that I'm looking at it once again, this is looking quite nice. So that's there. And obviously we will need a lot better battery technology. So that's another, I don't know, an idea to invest, or technology to invest in is battery technology, because solar and wind will need battery technology for them to be efficient. That's there. So when we basically take all of these things together, what I'm looking for, or what my base case for the world, I guess I do want to talk about this as well. So before I give you my summary, so this is another very important chart here, and this is the M2 money supply of all of the major currencies in the world. So we're looking at China, United States, Euro, Japan, and Great Britain, and a bunch of other currencies as well. So this is showing me how much currency there is in the world, because the amount of currency units also will reflect into prices and in everyday goods and services, wages, all of these things. And we haven't seen a lot of money printing since 2020. So when we take a look at this chart, let's go back to the monthly chart here. You can see since 2008, we have been supported by this long-term trend line here for quite a while already. And whenever you see that we are touching a bottom here, it's usually in some form of a crisis. So 2016, there was a lot of shakiness in the world on the markets as well, but we were able to avoid a market crash after a lot of money printing here. 2020, we also, or even 2019, we saw a situation with the repo markets that kind of signaled a potential crash, and then we had 2020, and then we saw a lot of money printing. And since 2020, you can see the global liquidity went down a lot after the Russia-Ukraine war. Then it went up, down, up, and now we're basically at a decision time here, and we basically need to decide if we allow the markets to crash, or if there will be a lot of money printing, or what's going to be happening. But the global liquidity, as it is at an inflection point. So companies are doing well. Like I showed you, that companies are doing profits. Companies don't really have any major problems, in my opinion, as of now. But it's the consumers that have a problem. And consumers, when they have a problem, they stop buying stuff. And eventually when consumers stop buying stuff, then it will be reflected in company profits as well. So even though companies have been able to lower the prices of goods, they still need to do a lot of sales. So GDP basically has to continue to go up. So when I'm saying that companies are probably going to be doing good for the next 1 to 2 years, just because of this effect here, that's probably true. So I'm not expecting a crash immediately, but as you can see, there's a lot of different indicators here showing that a crash is basically behind the corner right about now. And I'm not expecting any kind of greed season coming anymore to the markets. So altcoins, I don't see a lot of bullishness going into altcoins anytime soon, unless governments start making some stimulus packages for some reason. And usually governments only do stimulus packages as a response to something big, for example, a market crash. So for that reason, I do expect that a major market crash, a black swan event, is basically behind a corner. And I don't know if stocks will go down a lot, but governments will have to respond by printing more money to basically save out their consumers, their people. And politically, it is very popular to print more money and save the voters from bankruptcy, personal bankruptcies. So all in all, what I'm kind of expecting on my base case here is that it's not a good idea really to invest in speculative assets as of now until we get stimulus packages once again. And right now, the governments aren't really talking about stimulus packages, at least that I'm aware of. The only stimulus packages that we are seeing is for war, pretty much. So, yeah. I don't know what will happen in the future. These are just a bunch of data points, and this is just my analysis. And when you take a look at this data, your final analysis or conclusion might be completely different. So I highly encourage you to think on your own and use these data points to actually form your own investment idea. Just follow me, because I've been wrong plenty of times in the past as well. But I'm just saying that speculative assets are probably not the play right now. So the best play is probably going to be companies that have very good price to earnings ratios, because their costs have gone down. And there's always need for energy. So energy like solar, wind, battery technology, that's probably going to be a high bet. But Nvidia, speculative stock, GameStop, I don't know. I would be a little bit wary right now, because retail investors don't seem to have a lot of money based on how much credit card debt they are actually accumulating here. So that's my analysis for this large macro view. Hope you liked it. Consider subscribing to the channel. And if you want to join the discussion, I have a free Discord group where you can join. The link is in the description, so we'll see you there as well. Thanks for watching this video, and I will see you on the next one. Bye bye.